What's up, investors? It's the Russian dude. Let's immediately talk about why do I think that the stock market right now is literally hanging by a thread, and what kind of these secrets we are expecting from the Federal Reserve, from the FOMC, because they are entering a so-called blackout period when they do not want to talk to anyone. To begin with is the upcoming problems with the stock market. Right now the expectations, the performance of the entire stock market, of the index S&P 500, like we already discussed many times before, is mainly thanks to just a handful of companies. Microsoft, Tesla, Nvidia, so on, they are the ones which are pulling the index and pretty much the entire stock market up. But at the same time, another major problem is that the expectations of the market participants, they are only going up. Well, I mean, whenever companies are beating the expectations, you only expect them to even be better during the next earnings season. For example, right here we have a graph which shows the forward PE ratio on average across the entire stock market. And as you can see, it is right now at its maximum levels since 2021. And obviously this expectation can only go up that much higher until at some point these companies do not beat their earnings report expectations and, well, the price comes crashing down. It is expected that on average the S&P 500 earnings will increase by approximately 9% in the second quarter, where we are pretty much right now. And if you just take the big technological companies, the very same expectation is that the earnings will increase by up the entire 30% on average, mainly thanks to Nvidia, which is crushing right now, which earnings are growing in triple digits, like non-stop. And these numbers, they obviously skew the data because, yeah, whenever you have one company that grows in triple digits and then another company grows like 5%, if you average them out, the average growth is like normal 50%. And the longer companies beat the expectations, the higher their share prices go, the more cautious investors become. Because, I mean, they see that the company is growing 10% and another 10%, 10% more and then 10% more. More and more investors, they start thinking that, well, correction is somewhere around the corner. I better sell now to lock in my profits. And most of the time, such trigger can be whenever a company does not beat its earning expectations, or even worse, when it completely misses its earnings expectations. Eventually, every single company on the stock market is going through this phase, so it is just a matter of time when these big technological companies, including Nvidia, at some point in the future are not gonna beat their earnings expectations, their share prices go down, and they will pull the entire stock market with them. And obviously beating expectations is even harder during the economy, which is getting slower right now, which is the goal of the Federal Reserve, because they simply want to start reducing the interest rates, and one of the things they need to achieve is to slow down the economical progress. And speaking about the Federal Reserve, the FOMC upcoming meeting, just like mentioned in the very beginning of this video, right now they are entering this so-called blackout period. And what it means is that they are not gonna talk to the media at all, to just reduce this to even remove completely the temptation for some headlines to appear, to make the market even more volatile. So they basically say that, guys, forget we exist. Whenever our FOMC meeting at the end of July will happen, this is when you're gonna know everything. Like, this is when you're gonna know everything that we know. And this time, the blackout period is going to last until the next FOMC meeting, which is happening on July 31st. And since we're right about to see the Federal Reserve pivot whenever they're gonna start reducing the interest rates, most likely it's gonna happen in September. This blackout period, which is only happening in July, well, it should raise just a little, at least a couple of eyebrows. Because, I mean, yeah, as you can see from this graph, the percentage, the probability that the Federal Reserve will cut rates in September at this point is pretty much 100%. Well, to be specific, 94%. That they also have some probability that there will be the second cut somewhere in November, and then there is even a small chance, but chance nevertheless, that there will be a third cut in December, so we might see 3 cuts before the end of 2024. And this Federal Reserve pivot, it always shocks the market, especially whenever they go from the phase of keeping the rates high to start reducing the rates. I mean, I mean, if it makes sense, it kind of makes sense that the situation should be completely the opposite. The Federal Reserve wants to restart the economy by making the interest rates lower, right? So this should theoretically boost the stock market. Well, that's not exactly the case. If you remember from one of my previous episodes, we were talking about exactly the opposite phenomena which is happening. Every single time since last like 60-70 years, every single time Federal Reserve pivot was happening, every single time they started to cut rates, the market was going down, anywhere between 5 to 56%. Then we also have this VIX graph, which basically shows the volatility on the stock market, and we're right in the beginning of the next season of an increased volatility. And why this should be a sign for concern, it is because there is a combination of Federal Reserve pivot, which will most likely cause the stock market to correct itself, at least because, let's be honest, the correction is overdue, at least in the big technological companies. And then it combines with the season of volatility, which means highs will be even higher and lows will be even lower. It honestly feels like we are right now sitting on the gunpowder barrel. I mean, this is the saying we have in my country. It kind of makes sense, right? Because yeah, as soon as there is one bad thing, one bad statement, one incorrect action, well, everything might go down very fast and very quick. And to end this video, right here is the picture which shows the upcoming earnings reports for this week. And a very interesting statistics is that so far the companies which already released their earnings report, only 62% of them beat the expectations, which is lower than the 5-year average of 68%. Well, as you can see, not that many companies, they start beat the earnings expectations. Could this be a sign for the upcoming trouble? I guess we'll know soon enough. And as always, thank you so much for watching. Please like this video, subscribe to my channel if this was interesting, informative, or both, and see you tomorrow.